Did you know that having over £10,000 in savings could put you on HMRC's radar? If you've been quietly building your savings or received an inheritance, this is a must-watch. But what if the rules have changed? What if there's something critical you're overlooking that could cost you thousands? Stay with me, because in this video, I'm breaking down everything you need to know about how HMRC monitors savings accounts, what thresholds you need to be aware of, and how you can protect yourself from costly mistakes. Don't skip this. It's not just about your savings, it's about your financial peace of mind. Why is HMRC interested in your savings? Make sure you like this video and subscribe, because we're diving into the kind of financial knowledge that could save you a fortune. So let's start with the big question. Why is HMRC so interested in your savings? Well, it's no secret that they're tightening their grip on tax compliance in the UK. Any amount of money sitting in your savings account isn't just yours to spend as you please. If it earns interest, it may also partially belong to the taxman. The rules might seem straightforward at first glance, but the deeper you dig, the more complex they get. For example, did you know that the amount of tax you owe on your savings depends on your total income for the year? Higher rate taxpayers have different allowances compared to basic rate taxpayers. If you're not keeping track of your interest earnings, you might already be in breach of regulations without even realizing it. Now, imagine this scenario. You worked hard, saved diligently, and finally hit that £10,000 mark in your savings account. It's a milestone, right? But here's the kicker. If your account generates more than the annual personal savings allowance, you'll need to declare that interest to HMRC. How many of you even know what your allowance is? For a basic rate taxpayer, it's £1,000 a year. For a higher rate taxpayer, it's just £500. And if you're an additional rate taxpayer, you get no allowance at all. Let me pause here and ask, when was the last time you checked how much interest your savings account has earned? Could you confidently say whether you've crossed your allowance threshold? This is where many people get caught out. Most savings accounts automatically reinvest your interest back into the principal amount. It's easy to lose track, especially if you're managing multiple accounts. But ignorance isn't an excuse. HMRC has tools and systems that track your financial activity. Yes, even your savings account isn't invisible to them. Through the Common Reporting Standard, CRS banks and financial institutions share information with tax authorities. That means your bank has already reported your interest earnings, whether you know it or not. So, what happens if you've crossed the threshold and failed to declare it? HMRC has the power to issue penalties for underreported income. And trust me, those penalties aren't light. You could face fines or even more severe consequences if they suspect deliberate evasion. Is it worth the risk? But don't panic just yet. There are legitimate ways to manage your savings effectively and avoid unnecessary tax burdens. One of the smartest moves you can make is to use tax-efficient savings accounts like ISAs, individual savings accounts. With an ISA, any interest you earn is completely tax-free. But here's the catch. The annual ISA allowance for the current tax year is £20,000. Have you fully utilized it? Beyond ISAs, there are other strategies to minimize your tax liability. Diversifying your savings into investments like stocks or bonds can spread your risk and potentially increase your returns. However, it's crucial to understand that investments come with their own set of risks. The value of investments can go down as well as up, so only commit to this path if you're comfortable with some level of uncertainty. And here's an underrated tip: seek professional advice. Financial advisors can help you create a plan tailored to your unique circumstances. They'll consider your income, tax bracket, and long-term goals to optimize your saving strategy. But let me ask, when was the last time you spoke to a financial advisor? For most people, the answer is never. Yet the cost of hiring one could be far less than the penalties and taxes you might face without proper planning. Now, let's talk about long-term implications. Saving is about more than just hitting arbitrary numbers in your bank account. It's about building a future you can count on. Whether you're saving for retirement, a dream home, or your child's education, every penny counts. And every penny you lose to unnecessary taxes or penalties is a setback to those dreams. If you're thinking, I don't have to worry because my savings are well under the £10,000 mark, think again. What about the future? What happens when you receive a lump sum from selling a property, a windfall from an inheritance, or even a generous bonus at work? Will you know how to handle it, or will you leave yourself vulnerable? So, let's dive deeper into the consequences of not reporting savings interest. You might think, it's just a few pounds of interest. Surely HMRC won't notice. But here's the thing, HMRC doesn't rely on guesswork. They have sophisticated systems in place to track every penny of taxable income, including interest earned from savings. If you don't declare your savings interest, and HMRC detects this omission, you could face penalties. These fines depend on whether your failure to report was deliberate or accidental. At the very least, you'll be required to pay the overdue tax plus interest on the unpaid amounts. For example, if you were unaware that your savings interest exceeded the personal savings allowance, HMRC may show some leniency. However, if they find evidence of deliberate evasion, the penalties can escalate significantly, sometimes up to 100% of the tax owed. Now, let's think about how easy it is to fall into this trap. If you have multiple accounts, maybe a regular savings account, a fixed deposit, and a joint account, it's surprisingly easy to lose track of your total interest earnings. Many people don't realize just how interconnected global financial systems have become. The Common Reporting Standard, CRSA, allows HMRC to receive information from banks, building societies, and other financial institutions not just in the UK, but around the world. This means that even if you have offshore accounts generating interest, HMRC likely already knows about them. There's no place to hide. If you've recently inherited money or opened an account overseas, be proactive and check whether the income is taxable under UK law. If you're unsure about your tax bracket, take the time to calculate your total income, including wages, pensions, and other taxable sources. One of the best ways to stay ahead is by using tax-efficient accounts like ISAs. As mentioned earlier, any interest earned in an ISA is tax-free. However, keep in mind that the annual ISA allowance is currently £20,000. If you have significant savings, you may need additional strategies. Other tax-efficient options include premium bonds, where any winnings are tax-free, or national savings and investments (NSA and II) accounts, which may offer tax advantages. If you don't already have a system in place to monitor your savings and track your interest earnings, start today. Many banking apps offer features to calculate interest. Use them, or better yet, use an online tax calculator to estimate your liability. Before we wrap up, let me leave you with this. Do you really know where your money is going? Do you understand how the tax rules apply to your savings? If not, it's time to take control. Review your accounts, consider switching to tax-efficient options, and don't hesitate to ask for professional help if you're unsure. Remember, it's not just about how much you save, it's about how much you get to keep. Take action today. If this video has opened your eyes to something new, hit the like button, share it with someone who might benefit, and subscribe for more insights like this. Let me know in the comments, what's your biggest concern when it comes to your savings?